Hello. Welcome to this Reed Smith webinar on Massachusetts' new NOL regulation and opportunities to maximize your Massachusetts NOLs. Before we begin, we wanted to cover a few housekeeping items. At the bottom of your screen, there are multiple application widgets. You can find a copy of the program slides by clicking on the widget that looks like a folder. And if you have any technical difficulty, there's also a help widget. For those of you who are unfamiliar with Reed Smith, we have the largest state tax group of any law firm. Our Massachusetts state tax practice includes appeals before the Department of Revenue and the Appellate Tax Board on sales tax and corporate excise tax issues. I'm Michael Jacobs, a partner in Reed Smith State Tax Group. Before joining Reed Smith, I was a partner in a Boston law firm handling state tax issues. With me today are two other members of Reed Smith State Tax Group who specialize in Massachusetts tax issues, Brent Beisel and Sebastian Watt. For today's webinar, we'll start with a discussion of the new NOL regulation promulgated on March 20th. We will then discuss some of the limitations that Massachusetts places on both the generation and usage of NOLs by certain types of corporations. Next, we'll talk about how the NOL rules interact with Massachusetts rules for combined reporting and the impact that certain types of restructuring transactions can have on a corporation's ability to use its Massachusetts NOLs. Finally, we'll discuss ways to maximize your Massachusetts NOLs either by increasing the amount available to carry forward or by reviving NOLs you might have thought were lost. Also, for financial institutions which can't deduct Massachusetts NOLs, we'll discuss some positions that could minimize any resulting phantom income. This webinar should run about 40 minutes. If you have any questions, please feel free to send us them using the contact information on slide 39. Now I'm going to turn things over to Brent, who will describe the new NOL regulation.
Thanks, Mike. Before getting into the content of the regulation, we wanted to give you a brief overview of its history. Often, looking at the history of a regulation and the different permutations a regulation has gone through can help with interpretation questions. The final version of this regulation was promulgated in March. However, as you can see, the working draft of the regulation was issued in April of 2019, nearly a year before the final regulation. A lot has changed in that year, particularly when it comes to the economic outlook. As we move forward in 2020, it may become relevant to consider that this regulation was drafted before the Commonwealth was facing a potential economic downturn. Considering this type of history can help fill the gaps when the stated intent isn't particularly helpful. For the new NOL regulation, the stated intent is reproduced on this slide. In short, the purpose of the regulatory change was to modernize the regulation. The prior version of the regulation had been in existence since 1993, and therefore, the new regulation was primarily an effort to bring the department's guidance into the 21st century. One of the biggest changes was extending the carry-forward period. The other big change was adding provisions into the NOL regulation to address the interplay between NOL utilization and combined reporting. After all, 1993 was well before Massachusetts moved to mandatory combined reporting in 2009. Later in this presentation, Sebastian will tell us how the NOL rules work in the context of a combined group. Before getting into the more complicated topics like combined reporting and the effect of restructuring transactions, in the next few slides, we're going to discuss the basic rules for NOLs embodied in the regulation. This is going to help us set the stage. We'll start with a couple of bedrock principles for generating and deducting losses on the Massachusetts corporate excise tax return. First, NOLs are computed after eliminating certain deductions. Some of these deductions are Massachusetts specific, such as the deduction under Section 38F for compensation paid to certain individuals, and the deduction under Section 38H for solar and wind power expenditures. But in addition, some federal deductions are eliminated or ignored for purposes of computing the Massachusetts NOL generated in a year. Examples include bonus depreciation and the federal production activity deduction. Second, NOLs are computed and applied on a post-apportionment basis. In this way, a corporation's NOL generation and usage for Massachusetts corporate excise tax purposes is expected to approximate the extent of its Massachusetts activity. Where it gets out of balance is where a corporation or corporate group has wide swings in its apportionment between the year it generated an NOL and the year it uses that NOL. Now, this can be a source of frustration to taxpayers who generated NOLs years ago, but seek to use those losses in years where there is significantly more of a Massachusetts presence. Later in this presentation, I'll tell you how this bedrock principle can create opportunities for taxpayers. Regarding carry-forwards, I mentioned a few minutes ago that the NOL regulation extended the time period for carrying forward losses. The old regulation allowed only a 5-year carry-forward. The new regulation adopts a 20-year carry-forward rule, which mirrors the federal rule prior to the enactment of the Tax Cuts and Jobs Act in late 2017. Massachusetts does not allow losses to be carried back to prior tax years. The carry-forwards are deducted after applying any allowable dividends received deduction. Thus, the DRD doesn't eat up a large portion of the carry-forward being used in the current year. NOL carry-forwards can only be used to offset 100% of the current year's net income. It cannot be used to create a current year loss. In other words, Massachusetts will not allow a corporation to deduct a full carry-forward from a prior year in order to create a current year loss. This would have the effect of rolling the expiration date of the old losses into a new loss with a new 20-year carry-forward. So this type of log rolling is not permitted. Along the same lines, the regulation requires that a corporation utilize its oldest NOL carry-forwards first. Now, this should help a corporation maximize the 20-year carry-forward period. Now we'll take a look at some basic limitations on using NOLs. The first type of limitation is based on a corporation's classification. Financial institutions, security corporations, and utility corporations are prohibited from using NOLs to offset their Massachusetts taxable income. Note that the utility corporation classification was repealed for tax years beginning after January 1st, 2014. The second type of limitation applies to all corporations, and it's based on nexus. The regulation provides that a corporation that generates a loss in a year in which it was not subject to tax in Massachusetts is prohibited from later using those losses to offset income in a year after it becomes taxable in Massachusetts. This can apply to a company that generated losses in a year it was not subject to tax by reason of being protected by Public Law 86-272. If the corporation subsequently becomes taxable in Massachusetts, either because it exceeded the protections under Public Law 86-272 or for some other reason, it won't be able to use the losses it generated in the protected years. To show an example how this works, consider the following simplified hypothetical. A corporation has revenue of $100 million in 2015 and expenses of $250 million. Thus, the corporation generates a loss of $150 million for the tax year. The following year, the corporation now has nexus in Massachusetts, and as you can see, it's moving toward a profit position. After deducting its expenses of $225 million from its revenue of $200 million, the corporation has a loss of $25 million. In 2017, the corporation flips to an income position because its revenues of $600 million exceed its expenses of $300 million. The result is income of $300 million. Now, for this example, we're going to ignore apportionment. The question then is, what is the allowable NOL deduction that may be taken against the income in 2017? Under the regulation, only the $25 million loss carried forward from 2016 may be used in 2017. The department's position is that the $150 million loss from 2015 cannot be carried forward into 2017 because the corporation was not taxable in Massachusetts in 2015. Now, we're going to come back to this example a little later in the presentation to talk about that $150 million. But first, I'll kick it over to Sebastian, who's going to take us into our next topic, NOLs, and combined reporting.
Thanks, Brent. So Massachusetts introduced mandatory combined reporting effective for tax years beginning on or after January 1st, 2009. That obviously introduced new complexity into Massachusetts NOL rules. So I'll start with some basic rules, walk through an example, and then we'll talk about some specific issues. So to understand how the combined group NOL works, we really need to start with how the tax base is computed. The first step to compute the Massachusetts combined group tax base is to compute the taxable income of each individual member. The taxable income of each member is defined as gross income minus the allowable deductions in the Internal Revenue Code. So although we're computing a combined group's taxable tax liability, Massachusetts is one of those combined group states that starts with the separately determined income of each group member. Special rules do apply, such as the elimination of intercompany transactions, but that nuance is important to get things like the charitable contribution deduction, the 153J limitation, and NOL carryforwards correct. Relevant to us, the taxable income of each member is computed without regard to the federal NOL deduction. The second step is that a taxpayer adds up all of its separately determined taxable income of each group member to compute the combined group's taxable income. If the combined group has an overall loss, that's not our NOL carryforward. Unlike the consolidated net operating loss, or SKI-NOL, that's computed under federal rules, Massachusetts does not track the NOL on a combined group basis. Instead, the income or loss of the combined group is apportioned to each member using each member's apportionment ratio. The member's apportioned loss then becomes that member's NOL carryforward to future years. In this way, the NOL is a separate company attribute in Massachusetts. Importantly, NOLs are not trapped in the entity that generated the loss, like in some other states. Massachusetts allows group members to share losses with other group members. There's some special ordering rules and limitations on sharing. For example, a member must apply its loss carryforward to its income before it can share with other members. And if it does share its NOL, it has to do it proportionally with other members. It can't share a loss with certain members, such as financial institutions. Okay, with that background, we'll walk through an example. Let's assume we have three taxpayers, X, Y, and Z, for all members of a Massachusetts combined group. Recall, step one is to compute the separately determined taxable income of each member, subject to Massachusetts adjustments and combined reporting rules. Here, we'll assume that X and Y have income of $50 and Z has a $200 loss. The combined group's taxable income is simply the sum of X, Y, and Z's taxable income, or a $100 loss. That $100 loss is not our NOL. Rather, the loss is apportioned to each member. Let's assume X's Massachusetts apportionment is 10%. To compute its apportioned loss, we simply take the $100 of group loss and multiply it by X's 10% apportionment. In this way, X's apportioned loss is $10. We do the same thing for Y and Z. We're assuming Y has 20% apportionment, so its loss is $20. And Z has 10% apportionment, so its loss is $10. Okay, so let's see what happens when we carry those losses into an income year. In year two, let's assume X and Y have income of $50 each, the same as last year. This time, Z has $0 of income. So the combined group's taxable income is $100. Okay, similar to last time, we'll apportion the group's taxable income to each member. We're assuming X's apportionment in year two is 5%. Its apportioned income is the $100 of group taxable income multiplied by 5%, or $5. We're assuming Y has 30% apportionment, so its income is $30. And we're assuming X has 20%, Z has 20% apportionment, so its income is $20. Okay, so now let's look at how the NOL carryforward works. Each member's NOL carryforward is simply its apportioned loss from the prior year. Applying X's $10 loss carryover from year one to its $5 of income in year two means that its income is $0 and its remaining NOL is $5. Applying Y's $20 loss carryover from year one to its $30 of income in year two means that its income is $10 and it has no remaining NOL. And applying Z's loss carryover from year one means its income is 10 and it has no remaining NOL. But that's not the end of the story. X is permitted to share its remaining NOL with Y and Z. That sharing has to be proportionate. So to figure out Y's share of X's NOL, we take Y's $10 of remaining income, and we divide it by the total amount of the group's remaining income, $20. We then multiply that ratio, 50%, by the NOL to be shared. X is $5. X gets half of X's remaining NOL. So after X shares $2.50 of its NOL with Y's taxable income is $7.50. The computation is the same for Z. So that's the basic overview of computing NOLs of a Massachusetts combined group. We'll now hit on a few special rules. So first, NOLs stay with a group member even if the member leaves its group or becomes a member of another combined group. That is, NOLs remain a separate company tax attribute. If a corporation that was a member of a combined group enters a new group, it's generally prohibited from sharing that NOL with members of the new group. There's an exception. The member is allowed to share its NOL with any member of its new group that were also members of its old group. Or said another way, NOLs can be shared to the extent there's continuity in the membership of the old and new groups. There's special rules for allocated income and losses. An allocated loss becomes a separate tracked loss carry forward. A member can use its allocated loss carry forward to offset either its own allocated income or its apportioned share of combined group income in a future year. An allocated loss has to be applied to its allocated income before it's applied to offset its apportioned share of combined group income. And importantly, an allocated loss can't be shared with other group members. There's also special rules for the treatment of capital gains and losses in a combined group. Basically, the capital gains and losses are removed from the tax base of each member. They're computed at the combined group level, subject to special rules. Then they're allocated or apportioned back to each member. To the extent there's a capital loss allocated or apportioned to any group member, that capital loss cannot be used by the member to offset apportioned non-capital income, and it cannot be carried forward. Finally, there's also special rules for NOLs generated in years before combined reporting became mandatory in 2009. The general rule is that a member can carry forward pre-2009 losses to offset income in later years, but it can't share those losses with other members of the group. There's also special rules governing the conversion of pre-2009 losses, which are computed and tracked on a pre-apportioned basis, to be applied against post-apportioned income in combined reporting years. Finally, what is mentioned that any use of the 2009 NOL is subject to a cap. It's a bit complex and subject to a number of adjustments. The cap is the numerator of a taxpayer's factors in the year the NOL was generated, divided by the combined group's current year denominators, but multiplied by the member's current year income. There's also special rules that allow a member to increase the property and payroll numerators in that formula, thus increasing the cap. If you have capped pre-2009 NOLs, you may want to have a second set of eyes review your calculation to see if there's any opportunities to reduce the cap and increase your NOL utilization. This is still an issue that we're seeing on audit. Now I'll turn it back over to Mike to talk about some restructuring.
Thanks, Sebastian. In today's environment, preserving tax attributes like NOLs is of paramount importance. As we come out of the current shutdown, we can expect to see an uptick in restructuring transactions, both mergers and acquisitions and transfers to creditors. Some of these transactions could result in the imposition of limitations on or the complete elimination of a corporation's Massachusetts NOLs. However, if you're aware of the rules, you can avoid some traps for the unwary. First, it's important to remember that Massachusetts' 20-year carry-forward period for NOLs is measured in tax years, not calendar years. So anytime a transaction results in a corporation having multiple short tax years in the same calendar year, this is going to have an impact on the remaining life of the NOLs. For example, consider a scenario where corporation A has a tax year that ends on October 31st. On November 30th, the shareholder of Corporation A transfers all of the stock to Corporation B. Corporation B has a tax year ending December 31st. Because of this transfer, A becomes part of B's Massachusetts combined group. Now, for purposes of this example, we're assuming there's instant unity. This will result in A being required to file 3 corporate excise tax returns for periods ending in the calendar year 2020. One for the period ending October 31st, another for the period ending November 30th, and a third as part of the Corporation B combined return for the period ending December 31st. This will result in any Massachusetts NOLs carried into the year ending October 31st, 2020, losing 3 years of life by the end of B's tax year ending December 31st. Another trap for the unwary is that Massachusetts does not follow the federal carryover rules for tax attributes that are in Internal Revenue Code Section 381. Therefore, Massachusetts NOLs do not automatically carry over to the surviving corporation in a merger, reorganization, or liquidation transaction. Instead, Massachusetts NOLs are tied to the corporation that originally generated the loss. Consequently, when a corporation with a Massachusetts NOL merges into another corporation and ceases to exist, the corporation's NOL is lost. This inconsistency with the federal rules can be a trap for the unwary. One way to avoid falling into this trap is to plan any merger or reorganization transaction so that the corporation with any Massachusetts NOLs is the survivor. For example, consider a situation in which a merger is planned between Corporation A and Corporation B. A has Massachusetts NOLs accumulated in a prior year. If the merger is structured as a merger of A into B, with B surviving, then A's pre-merger Massachusetts NOLs will be lost. However, if the transaction be structured as a merger of B into A, then after the merger, A's pre-merger losses will still be usable, subject to any restrictions resulting from the change in ownership in A's stock. For the same reason, when two or more corporations are consolidated into a single new corporation, then all the Massachusetts NOLs of the corporations that were consolidated are also lost. There is one exception to the general rule that Massachusetts NOLs are tied to the corporation that originally generated the loss. If a transaction is treated as a tax-free organization for federal income tax purposes because it is a mere change in identity, form, or place of organization, the so-called F reorganization, then the Massachusetts NOLs will carry over to the surviving corporation. For example, let's assume Corporation A is a Massachusetts corporation and it wants to convert into a Delaware corporation by merging into a newly formed corporation with the same ownership and capital structure as A. This merger would be treated as a mere change in A's place of organization, and any pre-merger Massachusetts NOLs of A would be available for use of the Delaware corporation after the merger. Another situation that can act as a trap for the unwary is the merger of two corporations that are part of the same Massachusetts combined return group. In this scenario, you might logically assume that NOLs that were generated in the year in which both corporations were included in the same combined return would continue to be usable by the surviving corporation after the merger. After all, as Sebastian noted earlier, such NOLs are shareable. However, that's not the case. The general rule still applies that the NOL belongs to the corporation that originally generated the loss or was assigned the loss. As a result, when a corporation ceases to exist, that loss is lost to all members of the group. Stock acquisition can also impact a corporation's ability to use its pre-acquisition Massachusetts NOLs. Massachusetts generally follows the federal NOL limitation rules in Internal Revenue Code Section 382. Under these rules, after an ownership change, NOL carryforwards generated before the ownership change can only be used up to an annual limitation amount. This amount is computed by multiplying the value of the lost corporation at the time of the ownership change by an interest rate set by the Internal Revenue Service. Massachusetts also applies this annual limitation on NOL usage. However, for Massachusetts purposes, it's required that the limitation be adjusted to reflect that a only a part of the lost corporation's taxable income is subject to tax in Massachusetts. This is accomplished by multiplying the federal limitation by the ratio of the corporation's taxable income for Massachusetts purposes to its federal taxable income. Massachusetts also follows other federal limitations on the use of NOLs, like Internal Revenue Code Section 269, which disallows the usage of pre-acquisition NOLs when an acquisition was made to evade or avoid tax. Now I'm going to turn things back over to Brent, who will discuss some ideas for increasing the amount of your NOL carryforwards, including NOLs carried from years that were otherwise closed.
Thanks, Mike. We'll start our dive into the opportunities for taxpayers with the idea that taxpayers should look at each return as a way to revisit the computation behind the generation of NOLs in a prior year that are being carried into the current year. For example, if I'm carrying losses into 2020 that were generated in 2013, I can revisit the 2013 calculation as a way of adjusting the NOL carryforward available for 2020. Even if the tax year in which the loss was generated is closed under the statute of limitations, adjustments to the amount of the carryforward are not controlled by the statute of limitations applicable to the original return. Instead, adjustments to the amount of the carryforward are controlled by the statute of limitations applicable to the year the carryforward is used. In our example, even if the 2013 tax year is closed under the statute of limitations, you may be able to take the position that that is irrelevant to the amount of carryforward available in 2020. The statute of limitations that applies to making adjustments to the carryforward is the statute of limitations for the 2020 tax year. Now, at first blush, this might seem like an aggressive position. After all, what you're really arguing is that there is a 20-year statute of limitations for loss years, because you're arguing that you can adjust the carryforward whenever it is used in the 20 years before it expires. However, this is a position that the department has taken and asserted against taxpayers at audit and in appeals. In a case that was recently resolved at the Appellate Tax Board, it involved this scenario. The taxpayer was audited for its 2007 through 2009 tax years. During the audit, the department adjusted the amount of NOLs carried into those years on the basis that had it audited the taxpayer's 2002 through 2006 years, it would have made certain adjustments that would have reduced the amount of NOLs generated in those years. Now, as a result, the department asserted that it was valid to adjust the NOL carryforward for the 2007 through 2009 tax years, even though 2002 to 2006 were closed for assessment. If the department takes this position, taxpayers ought to do the same when it benefits them. And as shown by this recent case, the adjustments can relate to hypothetical changes that a taxpayer would have made if they could recompute the tax for the year the loss was generated. As another example, consider a taxpayer that generates a loss in 2013 using the standard double-weighted sales factor apportionment formula. Because the taxpayer had substantial operations outside of Massachusetts, double-weighted sales resulted in a lower factor than using a single sales factor because it included that substantial property and payroll outside of Massachusetts. Flash forward to 2018, and the taxpayer now concludes that it is actually a manufacturing corporation that must use the single sales factor rule. Now, maybe there was a department audit for one of the interim years, and the department determined that the corporation was a manufacturing corporation, or maybe the corporation was simply revisiting its prior determination. In any event, on the 2018 return, the taxpayer says, boy, if I had used single sales factor in 2013, it would have resulted in a higher apportionment percentage. And since it was a loss year, I would have generated more Massachusetts NOLs to carry forward. Since the taxpayer is going to use those NOLs to offset its 2018 income, it can adjust the carry forward by recomputing its 2013 loss as if it was a manufacturing corporation subject to the single sales factor rule. Changing the apportionment percentage is just one potential avenue to adjust the NOL carry forward amount. Depending on your facts, there may also be opportunities to adjust the net income calculation itself by adjusting an add back, for example, or an expense computation. In addition, you may be able to take a position that you can make adjustments for years even when there was no original in the loss, under the idea that the corporation had nexus with Massachusetts in a year when it had a loss. Yes, we think the same rule would apply in that situation and would allow a taxpayer to argue that it has additional losses carried into the current year. Remember our example from earlier in the presentation where we were discussing the limitations on a taxpayer's use of a loss? In our example, we had a taxpayer that generated a $150 million loss the year before it was taxable in Massachusetts, a $25 million loss the first year it was taxable in Massachusetts, and $300 million of income in the subsequent year. We said that under the department's regulation, the $150 million loss could not be carried forward into 2017, and only the $25 million loss was available to deduct in 2017. However, using the department's audit and litigation position gives us an opportunity to argue that the $150 million loss from 2015 can, in fact, be used in Massachusetts. When computing the 2017 return, or as the basis for a refund claim, the taxpayer has the opportunity to reevaluate its nexus determination for 2015, and if the facts support it, argue that it had nexus in 2015 and should be entitled to carry forward the loss to 2017. This would result in a total carry forward of $175 million that is available to be deducted in 2017, the $150 million from 2015 plus the $25 million from 2016. Now I'll turn it over to Sebastian, who will discuss another opportunity related to prior year NOLs.
Thanks, Brendan. So if you had an entity that was at one point classified as a utility corporation, a financial institution, or security corporation, then lost its classification, then this next issue could apply to you. We'll use utility corporations as an example. Before 2014, utility corporations were subject to a tax other than the general corporate excise tax applicable to most corporate taxpayers. That separate tax did not allow a utility corporation to claim a deduction for losses incurred in prior tax years. So in years that the taxpayer was classified as a utility corporation, the statute was clear, no NOL deduction. The utility corporation excise was repealed, however, for tax years beginning in 2014. Importantly, the provision disallowing a utility corporation from claiming a deduction for a loss carried forward was also repealed. But because of that repeal, there's now no statutory provision that disallows a corporation subject to the general corporate excise tax currently that prohibits it from claiming a deduction for a loss that is incurred in the year that it was subject to utility corporation tax. Therefore, the taxpayer could take the position that it can carry forward losses generated in the years that it was subject to the utility tax to offset income in corporate excise tax years. Similar arguments can be made for a taxpayer that was at once classified as a financial institution or security corporation, therefore prohibited from claiming NOL deductions, but subsequently lost that classification. That is, no statute explicitly disallows a corporation that is subject to the general corporate excise tax to deduct NOLs generated in years it was a financial institution or security corporation. The department probably disagrees with that position. For example, there's a regulation explicitly disallowing an NOL deduction attributable to losses generated at periods the taxpayer was a utility corporation. But there's a position that the regulation is contrary to the statute on the basis that the statute containing the NOL deduction prohibition was repealed. Now I'll turn it over to Mike to discuss some NOL alternatives for financial institutions.
Thanks, Sebastian. As Brett mentioned earlier, Massachusetts does not allow financial institutions to deduct NOLs generated in prior tax years. This prohibition can put a financial institution at a disadvantage and can result in situations in which the financial institution can have substantial Massachusetts corporate excise tax liability, even though it has no income in an economic sense. For example, Consider a situation in which a financial institution is subject to the federal mark-to-market rules for dealers and securities. Under these rules, a taxpayer is required to recognize gain or loss every year on its securities as if they were sold at fair market value at the end of the year. As a result, a taxpayer required to apply the mark-to-market rules could be required to recognize a loss on its securities in one year when the value of the securities decline, and then recognize a gain in a later year as the value of the securities recover. All or part of the gain recognized in the later year would just be the recapture of the loss that the corporation was required to recognize in the earlier year. For federal income tax purposes, this recapture of prior year losses would not have any tax impact because the prior year losses, to the extent they exceeded the corporation's other income, would result in an NOL carry forward. This carry forward would then be available to offset the corporation's income in the year in which the loss is recaptured. However, if the corporation is a financial institution for Massachusetts purposes, then any losses recognized in the earlier year would not be able to be used to offset the gain in the later years. This would result in the corporation being taxed on phantom gain. For example, consider a situation in which a corporation is required to mark down its securities by $400 in year one. Then, in year 2 and 3, the securities recover their value. And by the end of year 3, they have the same value they had at the beginning of year 1. Thus, the corporation really hasn't realized any income over the 3-year period. For federal income tax purposes, the corporation would also have no taxable income because it would be able to offset its income in years 2 and 3 with its NOL carry forward from year 1. However, for Massachusetts corporate excise tax purposes, the corporation is classified as a financial institution, so it would end up being subject to tax on $400 of income for the 3-year period, even though it was in exactly the same place that it was economically at the beginning of the 3-year period. What can a financial institution do to mitigate this disadvantage? One option would be to revisit the question of whether the corporation should be classified as a financial institution at all. There are several alternative tests for classification as a financial institution. Under one test, a corporation is classified as a financial institution if it is subject to regulation by the Massachusetts Division of Banks. If a corporation is engaged in an activity that might require such a registration, one option might be to conduct that activity in a separate subsidiary corporation so that the corporate parent can avoid classification as a financial institution and thus continue to deduct prior year losses. Under another test, a corporation would be classified as a financial institution if it derives 50% or more of its gross income from lending activities. Again, it may be possible for a corporation to avoid satisfying tests if it can isolate its lending activities in a separate subsidiary corporation. Now, if there is no way to avoid financial institution classification, there may be other options available. First, it's worth taking a closer look at the source of the corporation's income to see if any of it is really just recapture of prior year deductions or losses. For example, if the corporation has income that results from application of any federal mark-to-market rules, like the corporation in the example on the previous slide, consider whether the mark-to-market rules actually apply for corporate excise tax purposes. If the application of the rules was triggered by the federal consolidated return rules or was a result of an election that was made for federal purposes, then the corporation may be able to take the position that there is no requirement to mark-to-market for Massachusetts purposes. Another example would be if the corporation has income that results from the recapture of prior year depreciation deductions taken under federal accelerated depreciation rules. If the depreciation deductions resulted in NOLs that cannot be deducted for Massachusetts purposes, then the corporation may be able to take the position that its income should be recomputed for Massachusetts purposes as if the corporation had elected out of federal accelerated depreciation, thus resulting in less deductions and less losses in the earlier years, and less recapture in the year of disposition. There are also some other arguments that a financial institution can make to avoid taxation on phantom income. First, it could argue that the phantom income should be excluded from income for corporate excise tax purposes under the tax benefit rule. This rule, which is codified in Section 111 of the Internal Revenue Code, allows taxpayers to exclude income amounts that merely represent the recovery of amounts deducted in prior years, if the prior year deduction did not reduce tax. Now, the Appellate Tax Board has allowed taxpayers to apply this rule for purposes of computing net income for purposes of corporate excise tax. Arguably, the tax benefit rule would apply to the mark-to-market gain recognized by the financial institution in the example I gave previously, because the institution got no benefit from the mark-to-market losses that were recognized in the first year. Note, however, that there is Massachusetts case law holding that the tax benefit rule does not apply to depreciation recapture. Now, there are strong arguments that this authority is wrong. In fact, there is case law in other states that reaches the opposite conclusion. This doesn't mean that it won't be harder to rely on the tax benefit rule to exclude depreciation recapture. Another option for a financial institution would be to exclude any phantom income on the basis that it falls outside of the scope of the income that the Commonwealth has the authority to tax under the Massachusetts Constitution. The Supreme Judicial Court has held that the authority to tax income under the state constitution only extends to true economic income, and that Massachusetts can't tax fictional gain. A financial institution could take the position that items that merely represent timing differences, for example, mark-to-market gains that are just a recapture of prior year mark-to-market losses, are fictional income and should not be subject to tax. We hope this webinar has been informative and given you some ideas on how to maximize the value of your Massachusetts NOLs. Please feel free to reach out to any of us with questions using our contact information on this slide. Thanks for listening in.